Welcome to the Future of Supply Chain, presented by Dynamo. Each episode, we sit down with leaders in the industry as we build the future of supply chain together. Let's get into the show. Here's our host, Santosh Sankar.
Hey folks, welcome back to the Future Supply Chain Podcast. I'm your host, Santosh Sankar. And today we have a bit of a out of the norm episode where I'm joined by my colleague Madelyn, who many of our listeners know, and our new teammate Bola, who some might remember from an episode that Madelyn hosted around AI subject matter late last year in 2024. So first and foremost, Bola, we're super excited to have you on the team. And I'd love for you to just kind of give the listeners a personal intro and how, I guess, you made your way into the world of industrial investing with Madelyn and myself.
Thank you so much. Firstly, excited to be here, to be a part of the team. So my journey in the industrial world actually started early in my career. So I worked for General Electric as an aerospace engineer, working on propulsion systems. And if looking back, I've actually spent a decade of my career at the intersection of the industrial economy and AI. In 2016, I co-founded a company in the AI space using AI to predict where car accidents are likely to happen, which is a fun fact where I first met John directly. I actually pitched him at Dynamo. After that, I joined the AI fund after exiting that company. And I incubated a number of companies, but kind of central within that theme were three companies that I incubated in the industrial space, two of which spoke at Manifest this year at the same time, which is interesting. And one was one with Dynamo. Of course, we worked together to incubate Freight Hero. It was a great opportunity to really work closely with the team and really learn about kind of the approach to investing. And when I moved back to Europe, I felt it was the right time to just double down on that space. I think there's a lot of massive opportunity within that. And Dynamo is the I guess I'm biased now. Now I can join the team. I believe Dynamo is one of the sharpest and has the best perspective on this space. So really excited to continue to double down and invest in the opportunities here.
I'll say it's shocking you agreed to join the team given your first interaction was with John. So you must have caught him on a great day.
No, John is great. John is great. I understand the British humor, so I'll give him the pass. I'm also British too. John was great. I had a great experience with him. Was very thoughtful. Absolutely.
He's awesome. We're super fortunate to be able to work with him. But you had a very unique onboarding to the team, if I may, because a few weeks ago, the three of us, along with John, were with our CEOs for our annual CEO summit, and I can imagine that kind of gave you a whole lot of interactions to observe and then chew down on. And so, I guess my question is, what sticks out to you when you think about the founders that are building in this sector? Are there certain things that are must have, nice to have, you're going to run away from? But I'll kind of just leave it broad. Would love to hear your thoughts.
Sure. So I guess my kind of first, I guess just my observation. I think there are basically two buckets of founders that I've seen. I think one bucket is really, I'll call them industrial adjacent founders. These are founders that know the space really, really deeply, kind of have a very pragmatic view of building solutions that fits into the user's existing workflow. And it's really around, they understand the space, they understand the constraints of the space. And I think they are a smaller subset of, I would say, tech first founders who are often thinking about reimagining a whole workflow. I think both approaches can work and both approaches can succeed. I just think it's about aligning the right founder to the right problem. But I think the kind of the commonality across both of those type of archetypes of founders and within Dynamo's portfolio companies is that I just felt that the founders were very smart, very data driven, and very customer driven. And I think those are three kind of non-negotiable characteristics that you need to be successful in this space.
Amazing. Well, I'm going to shift gears here, Madelyn, to you, and congratulations on your promotion. One of my mentors once told me, you will have delight like you've never experienced when somebody that you have been able to mentor, invest in kind of levels up. And I wholeheartedly have felt that with you over the last 2 years. And so thank you. You've kind of been perhaps behind the scenes. A lot of folks may not realize that a lot of the work that you do helps kind of shape where we try to invest, but also you're out in front finding those relentless founders that we're looking to back. And so you're now the first principal that we've had at the firm. And I have to ask you here, as you're digging in, what's top of mind for you? What are you looking to invest in as we think about the future of the industrial economy?
Yeah, well, first of all, thank you so much. I've genuinely loved being a part of the Dynamo team, and I'm looking forward to continuing that work as principal. As far as what I'm thinking about for topic, so over the last 18 months or so, I would say I've leaned very heavily into the AI landscape, and that's reflected in some of the investments like Bola alluded to with Freight Hero, where we've uh, sort of dug into the services as software paradigm, which tends to work quite well in supply chain. And the bet we've made thus far is in the freight brokerage space, where you're automating key back office workflows, addressing that cost to serve metric really directly. I'd love to find further applications in other nodes of the supply chain, whether that's for carriers or manufacturers. But as we think broadly about the AI landscape and what it means for venture, it also unlocks some new models, which could be leaning into some traditionally services heavy businesses, which tends to define what is much of supply chain, and turbocharging those businesses with an AI tech stack. This is kind of happening broadly in VC as we consider how AI is changing the types of models that VC can practically back. And I think it's especially relevant for supply chain, where these are service oriented, highly manual, highly human centric businesses. So it's more of a full stack model, if you want to put it that way. The other piece of it is, and I'm sure we'll get into this later with kind of geopolitical tensions, the trade war, and thinking about reshoring, nearshoring, all of those sorts of buzzwords, but specifically access here domestically to critical materials, critical components, and what that means for how we source a lot of those goods. With the tariffs, which we'll talk about, the economics change a bit for accessing some of those goods. But also just our trade relationships are evolving, and we need to think more about how we can tap into existing resources. And so historically, there has been some talk around, the circular supply chain, and some of that has come to fruition. There have been some notable startups that have raised quite a bit of money in the space, like a Redwood Materials is a good example. And so we've seen some advanced recycling technologies. We've seen some B2B marketplaces, which effectively are trying to create some linkages between the supply and demand of some of those materials, metals, for example. And my question is there now within the current paradigm an opportunity for something new, where we can effectively source a lot of those goods here domestically in a venture scalable way? So that's kind of top of mind for me as we go further into 2025. And sort of circling back to your mention of the team, the addition of Bola, the change in role for myself, that comes alongside the announcement of our $54 million Fund 3 announcement. And so I would love to turn it back to you and just get your thoughts on what was fundraising in this environment like?
Yeah, it was tough. And that's probably a given, I would say, for most managers that are out in market raising a Fund 1 through a Fund 4, where Fund 4 is usually when you start to graduate or have graduated out of the emerging manager moniker that we still benefit from, I would think by and large. But it was challenging. When we started the fundraise out, we very quickly got to about 48 million relative to the 54 million that we have announced as our Fund 3 figure. Now, that is about 3x uplift from our Fund 1. And it's a really interesting time because it's about 10 years since John, Ted, Barry, and myself decided to kind of go have at it and attempt to raise a first fund. So a lot of what we're thinking about is kind of how different the world is, and equally maybe how similar it is from that inception moment to where we are now. as Dynamo Ventures. I do think that our subject matter has waxed and waned in and out of interest, and I would also say with interest is a deeper understanding, because nobody would have predicted we would have had a global pandemic about 4 years into the journey. And then now, a couple years after that's concluded, we're now waging a trade war unlike any other seen in modern history. And so this is once again kind of dinner table topic, as I would say. But if you're on the LP side, you're generally grappling with an uncertain market. Depending on the pool of capital you're stewarding and allocating from, you might be weighing the potential of an endowment type tax that is very much been mentioned in Washington several times. And it all comes down to liquidity, or rather a lack of liquidity. And you're seeing, I think, venture have a grow up moment as an ecosystem, looking at our peers in private equity and using some of the tools in their tool belt to say, hey, we can actually manufacture liquidity. We no longer just need to wait for an M&A event or an IPO, nor is it frowned upon to use another tool in the tool belt beyond those two tools, which for the better part of ventures kind of life as an asset class or an institutional asset class, secondary sales, LP tenders were shied away from and oftentimes frowned upon. But we also shared the news that we did complete a tender in our first fund. So those LPs that did participate were able to tender their shares, if you would, or stake. And that crystallized their return at about a 4x for those who sold entirely in order to manage their own liquidity needs. So growing up kind of as fund managers as well.
Definitely understand that. And you alluded to sort of that waxing and waning of the subject matter that we cover. I think our listeners would really benefit from understanding a bit more of the scope that we cover. If you could provide a little bit of detail there.
Yeah. You both know this. We've had our heads down this rabbit hole for, I don't know, the better part of this year. But we actually quietly unveiled a rebrand and an evolution as to how we talk about ourselves, right? So at Dynamo these days, we think about what we do and the work we do through the lens of supporting relentless founders that are shaping the future of the industrial economy. And a lot of this feedback was from fundraising, spending time with our peers. And when you get into the weeds, people understand, hey, supply chain, as we historically discussed it, was a very vast subject matter. But when you actually frame it through the industrial economy, it clicks a bit faster. And if I were to peel back the layers, I guess briefly, we now are thinking about the world as how we make, move, and monetize goods. We're not doing anything materially differently, but it is more representative of what we take interest in, how we think about those opportunities that we're the best fit for. And we also think can really redefine the way the world works around this industrial subject matter. So for those who want to learn more, you could go to our website. And you'll also be able to see, as you kind of click through our portfolio, how kind of very neatly our historical investments fit in this bucket. So if you think about the concept of making, right, you have things like Milk Movement that are building ERPs for the dairy industry, Bonks, who's doing something similar in the mid-market. We exited Factor Quality last year that was building QA tools as well for the manufacturing industry. But as you kind of think about then moving, right? You both mentioned Freight Hero. That's our AI play in freight brokerage. But historically, we've also done well in companies such as stored and warehousing, Gatic and autonomous vehicles for middle mile. And when we think about monetization, our most recent investment that was announced in Ceto a few weeks ago that Madelyn played a really big hand in, as well as legacy investments in Solvento and LogRock. Very much kind of our fiber, not something we're trying to be, just better articulating who we are.
I think that's really helpful clarification. And you touched on a few sort of recent investments, Freight Hero, Ceto. These definitely align with sort of that AI paradigm that we were discussing. And we can't bring that up without bringing up Bola's background with AI Fund and other roles. So would love to double click there. Bola, you're self-described pragmatic in your approach to building AI native companies. Could you expand on what you mean there?
Yeah, happy to, happy to. So in the first wave of AI, myself included, we got, everyone got excited about the AI wave. So this was the computer vision wave, and I found that a lot of myself and my peers, we were building a lot of really impressive technology without always knowing how it translated into business value. And a lot of those ideas were ahead of its time, and some just didn't have the right kind of customer focus. Today, I still, to be clear, I still value technical depth, and I still value technical differentiation. But I think it's really important to make sure that it's paired with customer value, with business relevance. And I think, especially at the pre-seed stage, you don't need to have all the answers from day one, right? In terms of from day one. However, it definitely needs to be a North Star. And I think the durable AI companies right now are those that are able to really connect their innovation to a customer problem and show ROI, not just show ROI, but show ROI quickly in the process. So that essentially that's what I mean. So it's really around this relentless focus or North Star around, how am I actually solving a customer problem? What metric I'm actually improving? I'm not dismissing technical differentiation. I definitely think you can create generational companies that way, but I think you just need to align it with the customer problem, the customer metric that you're trying to solve.
And touching specifically on your experience building Pradina, is there a particular lesson that you took away from that experience?
Yeah, so it's basically the same lesson as ever before, but I think I can describe it with maybe a bit more of a story around the Pradina story. So at Pradina, we had a really solid AI team. At that time, you had to build your own AI models, right? It's not like today where you can just call an API. But we had a really strong research, strong technology team, but we didn't focus early enough on translating that into quantifiable solutions for quantifiable business value for our customers. So, for example, we were building a solution that was able to predict where car accidents are likely to happen. So the metric I would walk into customer conversations in at that time was, hey, we have phenomenal accuracy. Hey, we have phenomenal precision. Hey, we have phenomenal recall, and so on and so forth. But that didn't really mean anything to the customer. The real metric, and I think it took me 2 years to figure this out, is loss ratio. All I care about is improving my loss ratio. And I think that is something, because of that mistake, and I've seen many deeply technical founders make that mistake. It's really, essentially the biggest lesson is really, it's great to have great technical differentiation, but how do you align that ideally to a customer metric? And I think, especially in this industrial space, you need to focus. I think there's kind of two things. One is being able to solve a metric or customer problem that that customer really cares about, and the second is to fit in seamlessly into their workflow. So yeah, I would say that's really the main lesson that I learned from that journey. And on that, we also have to eat our own dog food. Santosh, perhaps you can touch on how AI is changing how VC firms operate and the opportunity there.
Yeah. I'll really credit John with making this explicit and forcing the thought as to, we pride ourselves in trying to help our portfolio companies stay ahead of the curve and instigating thought around something like AI maybe well before it is obvious. And so the topic for the last year, if not a bit longer than that, has been, how are you adopting AI in substantial ways? And coming out of our CEO summit, it feels like AI is now thought in maybe two ways: core product, which we won't touch on for this kind of chat, but then operations. How do you streamline your processes, your activities, and also have less friction in your overhead work. And so kind of ripping that out and thinking about what the role of AI is now inside a venture firm, we're all about to go away and spend a meaningful part of our summer entirely replatforming Dynamo to what we're calling more AI native capability. And there are other very smart VCs thinking about this. I think what is not entirely clear is how one might quantify value. And I think also the quantification of value is over indexed on how are you picking better? How are you then harvesting better and realizing return better? And I think that's just a very long feedback loop to index on. And one may not be making the most optimal decisions if you're waiting for those types of metrics to come through. Instead, as we kind of dismantle what a firm is, and you both have heard me say it, I distill it down into three areas, which is sourcing, selection, and stewardship, and how we're able to make our lives a lot easier in the process in order to focus on those three subject matter more acutely. And if you think about it, what matters, it's finding kind of a really interesting investment before it becomes consensus. Being able to then shepherd that investment through the selection process, right? Doing our work, putting a term sheet out, winning the heart and mind of a founding team. And then stewardship is how do you help them, but how do you also manage a portfolio in a thoughtful way, knowing that liquidity or the game of liquidity has very much evolved. And so thinking about how you rip things out like our CRM, rebuilding our process, not to take the magic out of it, but how do we, in the AI world, think more efficiently and uphold the magic or the factors that have made us successful historically? With that as well, how do we get rid of old bad habits and maybe things that we valued 10 years ago, if you would, that no longer need to be valued per se for whatever reason, right, around that particular subject matter. And so I think we're going to move to a future where you'll see more mid-level senior investors that are very meaningfully leveraging AI to supercharge how they work and how they operate. That could create, I think, a talent pipeline issue for the industry that we all need to kind of step back and think about and solve. But I think what's more obvious right now is we need to embrace the power that AI gives us thoughtfully, because it's not good. It's not going to solve every problem we have or every opportunity in front of us. But I do think by the end of the year, at least for all of us, may not be as visible to the outside, Dynamo should be a far more efficient and well-run shop, which for some of our LPs, I can hear them ask me, how's that even possible? Because they're pretty damn efficient as is. So let's let them wait and we could chill. I'm going to bring us home here, and I'm going to kind of take us way off the path because we're sitting at an interesting time in just kind of the way the world's worked, right? We have rampant nationalism. We have very aggressive trade policy posturing globally. The U.S. might have been the sole instigator, but this is now becoming a global phenomena. And I personally, we've opened Pandora's box, and these things cannot get put back in. Mm-hmm. Countries and companies are rethinking their exposures, the risks they have to their global trading partners. And so just a few hours ago, prior to recording this, the U.S. and China further detailed what the hell they've been up to in Switzerland, sitting in that resort for 16 hours, I think I read. And so while we're still in the standoff, they've softened their stance, where they're saying for 90 days, we're going to drop tariffs. And I think mutually there will be 10% tariffs by the U.S. on Chinese goods. And then China is effectively saying, we'll keep a similar rate to U.S.-made goods, but we're going to figure out how to work better together. Neither side appears to want to really detach. I'd be curious how you both are thinking about this. What should our listeners be thinking about, especially those that are trying to maybe stay one step ahead of the media commentary?
Some of the things that come to mind for me, so when you think about the drastic change in the tariff levels, right? They soared up to 145% with China. They're now down to, you mentioned the 10% blanket tariff, plus they're keeping that 20% that the administration, is putting on for fentanyl related issues. So I think in the immediate term, there are a lot of importers whose goods have been kind of in limbo as they've been waiting to figure out what happens, because the 145% was just prohibitively expensive for them to bring their goods through ports. You see that reflected in the drastic decrease in volume flowing through our ports. So perhaps this 90-day pause brings some of those goods in and alleviates that bottleneck, at least temporarily. But the impact is that regardless, consumers are going to see higher prices, right? Whether it's 30% or 20%, whatever holds, that's going to be reflected on shelves, in the near future. And so the outcome of that is likely a decrease in demand. Consumers are going to pull back on their spending. And that has impacts on freight rates throughout the supply chain. We've been in a historic freight recession already where rates have been incredibly low. That was driven by the spike post-COVID, the buildup in capacity to meet that consumer demand. That demand dropped. The capacity didn't necessarily burn off as fast. And so, it's just a simple supply and demand equation where that price dropped. There was starting to be some recovery there, perhaps slow on those rates. But I don't think that we're going to be kind of through the thick of it quite yet. And in part because you have a suppression in demand that's sort of built into the system. The thing that I also worry about is eventually that demand is going to come back online, whether that's in 6 months or a year or 5 years. And, you're going to see as a result of that rate drop an increasing call in that carrier capacity and similar capacity to service those goods. So when that demand comes back online, if it's a fast enough change, you have this price shock basically built into the system that is somewhat of a ticking time bomb. So not sure exactly how that plays out, but those are the things that I'm thinking about. Bola, would be curious what's top of mind for you.
Yeah, I think to be honest, I think you've covered it. I think the only thing that I will add to that, I thought it was pretty interesting, are the kind of non-tariff restrictions that were also kind of removed. I don't know if it's fully confirmed, but certainly in commentary, there's conversation around China kind of alleviating or removing the rare earths restrictions. I think that's hugely significant, right? To the, again, coming back to AI, AI race, right? A lot of kind of and our chips, our compute are built leveraging some of these rare earths, right? And it could have directly impacted things pretty dramatically. I think the impact of those rare earth kind of restrictions, China has a significant amount, right? They've been ahead of the curve, actually, frankly, ahead of the US in making partnerships in Africa, building infrastructure in Africa to basically consolidate some of those rare earths. So it would have been a massive impact to the semiconductor technology industry. So I think the CEOs of these firms, the respective firms, at least on that side, I think are breathing a sigh of relief. Would that mean that the US reduces the restrictions on NVIDIA and selling in China? I don't know, but I think it definitely bodes well for the industry from a semiconductor technology perspective.
Bola, if I could add to one thing that you mentioned, you brought up the topic of AI, which, is a horse that we'll beat to death on this conversation. But when we talk about that change in freight rates, folks within the supply chain live and die by margin. Their rates drop, they become increasingly margin concerned. That changes the dynamic of the potential startups and technology that they're willing to take an interest in and put money behind. So no longer is it the case where you can show up as a external provider and say, if you sign this $50K contract in 6 months, your employees will be 50% more productive. That type of pitch is not going to get consume or customers over the finish line. And so that ties into this AI paradigm that we've been talking about, where you can sell the work directly, automating tasks directly, and you essentially have to show up and day one allow your customers to, we think of it as hitting the easy button. And so that sort of ties into the startups that we are leaning into more heavily in terms of our investment focus.
Yeah, yeah, absolutely, absolutely. I think that, and I think also just to double click on that as well. I think if there was one AI company offering value, right, trying to, it would probably be differentiated. But I think there is a little bit of AI fatigue, so there's even more kind of requirement to show your value from day one. So there's 20 AI companies offering to optimize my business in some way or the other. So you have to structure it in such a way that there is as little risk for the customer as possible, and the impact is really clear and quantifiable and quick. So yeah, for sure, I agree with everything you've said, and I think that's what we are playing out with our thesis and our investment in companies like Fur Hero.
I'm going to, I guess, shift to a set of data points that I oftentimes monitor in times like this is consumer confidence, because that's a proxy for consumer demand or how consumer demand might materialize. And then similarly, you have kind of the industrial gauge as well. So that's the manufacturing PMI. I would say on the consumer front, that appears to be growing increasingly grim as you look at some of that data coming through. While it is a reading and it is a metric, it can be a bit soft and not as substantive depending on who you ask. But I do have a bit of concern, because while consumer confidence appears to be waning, which, by the way, small business sentiment is waning very rapidly as well. And if you think about the US economy, most of our economic growth really is tied to small businesses who these days are sitting in uncertainty. They don't have the scale necessarily to cope with increased tariffs, or even kind of find new sourcing partners that are as economically available to them and the price points they sell at. So there's a whole lot of fog here. But kind of traveling to our CEO summit and equally being in New York last week, the airports were filled. People looked very happy. They were dressed for vacations. And so I'm not really sure what to think. Granted, some of those choices were likely made before this tariff rhetoric really took hold. But there's a whole lot of caution, I believe, we need to kind of enter the world with, even with this 90-day relief around tariffs. By the way, I believe that we might see maybe not quite a bullwhip occur, but a very supply-led stock up, where chief supply chain officers are not going to take any risks and say, hey, while we have this window, let's pull inventory forward, even if it means we're purchasing for needs even early next year. And we'll figure out where the summer takes us. Maybe we're better off at the end of summer. Maybe we're no worse off. But equally, there's a looming risk that we are at an impasse once more. The thing that is a bit challenging, though, is the manufacturing PMI that is sitting at a level that's below 50. If you're above 50, you're expansionary. If you're below 50, you are in a contracting cycle, and we're right about 50 right now. And it's not clear how the manufacturing sector in the US is thinking, especially if you're talking about things like rare earths input materials that were prohibitively expensive. Maybe some of this non-tariff talk is going to be a tailwind into realizing some type of reindustrialization. Whether it's the US, I think it's all fair to say we think about it as a more North America-centric thing. And we need to figure out how to embrace our friends both in Mexico as well as Canada to make that happen.
I think the key word that stuck out to me in that was uncertainty. And when you think about the life of a manufacturer and the planning one has to make for all of the components that you have to source, it's difficult to make budgeting and planning decisions when you don't necessarily know what your cogs are going to be in 30 days, 90 days plus. So they have this 90-day reprieve, but what does the world look like on the other day, on the other side of that? And so I think the uncertainty built into the system is causing a lot of headache in terms of planning. And then you talked about bringing inventory forward. You know, when we think about the key holiday season, much of that inventory is brought in by, I think orders have to be placed by about June or so. And so if you put a bottleneck on that inventory, it drastically affects what your holiday season is going to be like for retailers and others. So I think my takeaway is uncertainty makes it difficult to plan.
Well put. Well
Yeah.
put.
And I think just to add to that, I think I think I'll take maybe a different angle to that, in the sense of I think I was listening to a podcast the other day, really good podcast, really talking about the kind of impact of the 90-day pause. So this is separate to the more recent 90-day pause with China, and I think is actually really bad for business in the sense, and a lot of CEOs are holding back from investing even further, because I think that if there is bad news, you can deal with the bad news and execute your business and know what to do. If there's good news, you can execute. This kind of pause creates uncertainty, massive uncertainty, which actually freezes investments, because most people can delay 90 days, or what do we do? Do we do this? Do we not do that? They don't really have the data. And it seems to be changing so quickly that CEOs, businesses, investors, capital markets don't really have the data to really plan an effective strategy. So I think that's definitely the to re-echo the point that Madelyn made. I think the 90-day pause, I think it was meant to give certainty. I think even probably creates more uncertainty, actually.
On that piece, Bola, you mentioned sort of investments by corporates and the difficulty in planning. You know, we've sort of seen whispers of large corporates in the US pulling back on investments in new technology and innovation because they're in sort of margin protection survival mode. And the thing that I have in the back of my head is, the longer that happens, what are the long-term implications for an economy where the large corporates are no longer investing in the up and coming technology, and what does that mean for the US and its sort of positioning around the world when we lose that edge?
Absolutely, completely agree.
So I'm going to bring us home here, maybe on a more lighthearted topic: autonomous vehicles. Right? Our first investment ever as a firm was in a company called Starsky Robotics that was attempting to automate over-the-road long-haul transportation. As a result of COVID, that business is no longer with us. But a couple of years after, Starsky made an investment that many people criticize me for in a company called Gatik AI. And Gatik is proving to be one of the last people standing, and one of those few autonomous companies with real long-term customer contracts. But the news out of Waymo, which is more of a consumer-oriented play, has only grown increasingly positive. And I think over the weekend, it hit one of our Slack channels that Uber's CEO, Dara, came out and said, in Austin, the Waymo vehicles are way more utilized and busy than the human alternatives. And I'm curious kind of both your take here. Are you optimistic? Is there kind of some caution that we all need to bear in mind? But it feels like autonomy or autonomous vehicles are emerging out of the trough of disillusionment, which we've been sitting in for, I don't know how long, 3-4 years now?
Yeah, I can. So go on. I can definitely. I do think. I think there's a couple of things. One, I think the Uber CEO is talking his own shop a little bit. So I think we need to temper with that, right? Being able to tell the markets, the public markets, that his business is going to get more efficient, right? Over time with this technology is definitely good for the stock, for the share price of Uber. So I think we need to temper that to a little bit of reality. But I think directionally, I think that's correct. I have been in the Waymos when I was in San Francisco, and I had a pretty first time I was in it was pretty scary, but I've had a fantastic experience, and I know people. Especially, I think one of my mentors, she was saying that she actually prefers to get in a Waymo than to get in a Uber car, because she doesn't have the threat, or the threat of risk from the driver, right? When traveling at night, it's fairly safe, right? It's just you and the machine. So I think that's really positive. I think one of the interesting observations, and time will tell, is earlier on in the AV kind of market, there was really discussion that Tesla would lead it because Tesla had the most amount of miles, 10,000, I don't know, whatever billions of miles that it had. Waymo didn't have a vehicle. It was a no-brainer that Tesla was going to win it. But I think that, that's not playing out. Waymo seems to have the best technology. So I do think this market is here, but I think it's a deep pockets game, and I'm glad we have a fantastic investment in that category for sure.
You mentioned your friend who feels more comfortable in a Waymo because of the lack of threat from a driver. I know Santosh has texted me saying you're gonna love Waymos because they're so much smoother and you're not gonna get car sick. So I am looking forward to it for that reason. I think also I'll come at it from the side of the consumer perspective, because I was actually watching sort of a program about this weekend. It seems like consumer sentiment has really changed on sort of the level of comfort with these autonomous vehicles. I think, the big headline over the last couple of years was the accident with Cruise, and the subsequent lawsuit. That seems to have bowled over a little bit. I mean, Cruise has effectively shut down their operations, and now it's really Waymo leading the charge. But consumers seem to be much more comfortable with the technology. And they actually made a point, which is when Waymo launches in a new city, they will actually run the cars just completely empty for a period of time, just so consumers see them on the road and get comfortable before they even start offering rides. And I think that appears to be an effective strategy thus far.
Indeed. I'll bring it home by saying I think this is going to be unlocked for a lot of other things. So, for example, Madelyn and I were out in Dublin late last year on a return journey back from Slush, and we're able to experience what drone delivery looked like at scale. And there was a similar level of like that fluttering that you feel in like that magic moment when your Waymo comes up and there's nobody in there, you get in and you complete your first journey. There's a version of that for drone delivery as well. And equally, I think our partnership with Bobby and the team at Mana, I think you're going to see a lot more interest and realization that is not in the future. That is actually present reality. And it's just a matter of fact where it becomes ubiquitous. So all to say, there's a variety of factors that are very much kind of playing into the industrial economy, how we think about making, moving, and monetizing the things that we consume, all the physical stuff around us. And there might never be a better time to actually be in the position we're in. So with that, to our LPs who have trusted us, thank you very much for your support and your belief in us. And equally to our founders who are doing all the hard work, keep it up. You know where to find us. For those of you who want to get started on your journey, send us a note, hello@dynamo.vc. But with that, Bola, Madelyn, thanks for joining me. Let's get to work.
Thanks for watching. Follow us at dynamo.vc for all the latest episodes. We'll see you next time.